Welcome back to The Stage, powered by the Center Square. Housing prices are rising across the U.S. We'll now go to the Center Square publisher Chris Krug and PhD economist Orphe Divounguy, who discuss this in their latest episode of Everyday Economics. Let's have a listen.
$440,600 is an all-time high, but prices only rose 1.8% over the year, while inflation's running near 3.8%. So how is a quote-unquote record high house actually losing value, and why should that gap matter more to a family than the word record? What do you say, O?
I mean, you said so many things, man. Look, at the end of the day, people are paying more for less.
Okay.
And that's what's going on. And a part of the problem is the supply shocks that we've had, right? So we had it really all started with, right, during before the current administration, the record spending pushed inflation higher. Okay, that was on the demand side, but even before that, we had COVID. COVID was a major supply shock. Inflation soared. Then we had the massive stimulus package where basically the government decided to send checks to people that didn't even need the money. By the way, some of the stimulus was absolutely necessary, okay? But, I got a check and I really didn't need it, right? And lots of people like this across the economy got a check in the mail during COVID who didn't really need it, and they either saved it, bought a second house or something, bought a new car, or basically, and some of the savings, by the way, some of the ones who saved it spent it, right, over time. And those savings have dried out now. But the bottom line is this. You fast forward, we get inflation starts to come down, and then we get tariffs. And so who's really paying for the tariffs, right?
Yeah.
I think that's really important, right? The tariffs do not just hit consumer prices all at once. They move through the economy in stages. A tariff is a tax on an imported good, right? But a company importing that good does not necessarily raise its price right away the next morning. Businesses have choices. They can absorb the higher cost, accept lower profits. They can try to negotiate with suppliers. They can cut costs elsewhere. They can stop hiring. We got a little bit of that too. And they can raise prices eventually, right? And this process takes place over a long period of time. And now what we're seeing in today's economy is a combination of two things, two shocks. We're seeing the tariff shock from a year ago, and we're seeing the oil and gas prices, which, by the way, are starting to come down. Thank God for that, right? Although, of course, we got news over the weekend that the conflict is like, I don't even know what's going on. There were some things that caused, the conflict to reignite, and I don't know what's gonna happen with gas prices as a result of that.
Right. There's less certainty there than there was.
Exactly. Just a week ago, right? And really great research from the New York Fed tells us nearly half of the businesses that directly pay tariffs say they still have price increases coming. And so, yes, we're at 4%, 4.2% inflation, and hopefully we get some relief on the gas front, hopefully. But with what's going on, I'm not so sure anymore. And at the same time, we have the tariff price increases that are still coming. So is inflation really going to come down? I'm hoping. Yes, a little bit this year. But, there's a lot of uncertainty around my forecast.
Yeah. Well, so here's what's kind of caught my eye. I mean, I like to go back and look at what we've talked about in the past and kind of like sort of, kind of use them as milestones. So last October, you told us housing would keep dragging inflation lower. You had rent easing to 1.8% this year. Now you and your colleagues at Zillow have it holding closer to 3.1%, with owners equivalent rent near 3.4%. That's a real reversal. What did you see that kind of flipped you? I mean, are you rolling along with the trend here, or is there data in the market that you're that you're specifically zeroed
Yeah,
in?
totally. I mean, it's very simple. It's what we're looking at in terms of asking rents, right? So if you look at apartments that are on the market right now, what you see basically is that, rent increases have started to firm up. Rent growth is no longer decelerating. And so if that continues, right, and things continue to move higher and higher and higher, right, and rents begin to reaccelerate. But when I say reaccelerate, I should really say normalize. Rent growth is really low right now.
Sure.
So if you see a normalization in rent growth, that will put some upward pressure on potentially on the CPI, because it takes time for asking rents to show up in existing leases, right? Remember, asking rents or rents that are currently on the market, people are looking and they're like, oh, all right, this is a new rental I'm going to get into, right? It's not an existing lease. It's a new lease getting ready to start. And so in the CPI, which kind of proxies existing leases, you're likely going to see this upward shift. Now, here's the good news. The good news is that shift up is really, it's really at the beginning. You're not really seeing a big shift. You're seeing just the fact that there's no longer deceleration, right? And so I think that's the good news. The bad news is if you do see, with builders pulling back on new construction, if you do see an acceleration, a decline in vacancy rates, which would coincide with an acceleration in rents, then that housing deceleration that was helping is no longer going to be a tailwind when it comes to seeing CPI come down.
Well, all right. So one last question. So this week tells us something. We have pending sales. Housing starts up to 1.31 million. Builder confidence coming out Friday. We're not anticipating great news there. If you're watching for the kind of the break in the market, the moment this stock market breaks one way or other, which one of those tips you off first, and what would it have to say?
CPI, of course. You cannot. Everything else is kind of pointing in the same direction. You have an economy that's kind of treading water. CPI is, where is inflation headed? Is inflation going lower? Is inflation stuck around 4%? That is what I'm looking for, right? Can we get a lower than expected inflation reading? If we do, then yields could come down a little bit. And that means that everyday people will eventually see a slight easing in the cost of borrowing. If we do not see a lower than expected reading, or we see a higher than expected CPI reading, then we're going to feel more pain in the foreseeable future. For the foreseeable.
Well, thanks as always, Dr. O. That's Everyday Economics, part of the States, the Center Square's daily news magazine on YouTube and across streaming platforms.